If you make over $400,000 per year and you're sick and tired of losing hundreds of thousands of dollars in tax bills every single year, you already know that there's a way to buy real estate and almost wipe out your tax bill by bringing your total taxable income to zero. But the problem is you still haven't taken the leap, because over the past 5 to 10 years, while you've been making a lot of money, you've been literally throwing away hundreds of thousands of dollars and perhaps millions of dollars, while other people are actually buying properties, wiping their tax bills to zero, deploying that savings into their retirement portfolio of Airbnb properties, and crushing the competition. And I know why you haven't gotten started, because after helping hundreds of clients every single year do this, and hundreds of repeat clients last year buy properties for low money down, get massive tax savings that wipe out their tax bills, and after closing on a portfolio of close to $10 million for myself, there are 3 specific things that get in the way of first-time real estate investors, and I'm going to cover those right now so you're clear on how to get started the right way. The first thing everyone gets wrong is the taxes and cash flow equation. So Warren Buffett, arguably the greatest investor of our generation, has rule number 1 in his investing strategy: do not lose money. And rule number 2 is see rule number 1. If you are somebody who's making hundreds of thousands of dollars per year and you are literally losing 20 to 35% of your money to taxes, this is insane. And American taxpayers have been brainwashed into thinking this is normal and believing that this is okay. To put this in perspective, imagine any other person in your life charging you a 25 to 35% tax on everything they do for you. Imagine your retirement planner saying, "Hey, Mrs. Johnson, I'm going to help you grow your retirement portfolio. I'm going to charge you 30% of everything I do for you." Or imagine a 35% fee from a mutual fund money manager, someone who manages your money and says the exact same thing. "Hey, every time you make money, I'm going to take 35% of it." But for some reason, because the IRS has been a part of our life ever since we started making money, we just believe and have been brainwashed into knowing that this is okay. That is not the case. So the number one belief to shift and the new belief to adopt is: I, as an investor, will never become wealthy if I lose almost 20 to 30% of everything I make every single year. This is the number one belief that separates successful short-term rental or Airbnb real estate investors from everybody else. And the reason for this is 99% of people who are starting their real estate investing journey have one thing in mind, and it's the most frustrating thing imaginable. Their number one metric is something called cash flow, which I call slow money. This peanut dollar amount that happens every month or every year that people somehow believe they're going to retire off of by building this massive portfolio of real estate, living off the cash flow, and then retiring in the next 5 years. Well, the reality is investing for the purpose of cash flow, with cash flow being the number one thing in mind, is literally incorrect. This is what we call slow money. And I don't blame you, because I myself have read every book there is on real estate investing, from the 1970s to the 90s to the 2000s, and every book literally talks about doing real estate for the passive income or the cash flow. But the problem is this is a super outdated, old, antiquated method that does not actually resonate with today's real strategy. You see, 10 years ago, when short-term rentals became a massive thing, nobody really recognized the true value add that short-term rental investing or Airbnbs actually offer. Airbnbs and short-term rental investing offer this magical thing called bonus depreciation, and this will literally change your life. And to prove this, go to our homepage, mybnbaccelerator.com. Look at all the case studies and the testimonials we have from clients. Not all of them are talking about cash flow, this slow money thing that happens every month or every year. They're focused on the big thing, which is hundreds of thousands of dollars in net effective tax savings. And that, my friend, is the fast money. And this is the equation, this is the math that people truly do not understand. And if you figure this out, you will be in the top 1% of short-term rental real estate investors of all time. So the money math is this. Let's say you make $600,000 per year. Your tax bill is going to be somewhere between $170,000 to $240,000. Let's say this year you buy $1 million purchase price Airbnb. So let's say instead of doing this on your own, you find it with our company, we negotiate the terms, we get the purchase price that makes sense, we go under contract, you get it live with the help of a co-hosting company, you've closed, and now the property is live. Well, here's where the bonus depreciation comes into play. So at the end of this calendar year or the beginning of next year, you're going to order what's called a cost segregation study. A cost segregation study is this thing that is done by a third-party company that's going to analyze the property, the value of everything in it, and the adjusted lifespan of everything within that property, and spit back out this one magical number, which is effectively going to be the number that you can take as bonus depreciation year one and accelerate a bunch of tax savings into this same year that you buy and close on this property. So in this example of $1 million home, the average range that we typically see for bonus depreciation, according to third-party cost segregation study companies, is typically between 25 to 35% of the total purchase price. So for simple math, in this example, let's use $300,000 in bonus depreciation. So in this example, your household is making $600,000 per year. That $300,000 bonus depreciation drops your income in half. So the math so far is $600,000 per year income, $1 million real estate property, $300,000 in bonus depreciation. You just cut your income in half. Now, let's say you don't stop there. Let's say you do the exact same thing again in this same calendar year. You buy your second real estate property, another Airbnb for $1 million purchase price. Let's say the exact same cost segregation study company comes back and says this one, 30% bonus depreciation or $300,000 in accelerated depreciation this year. Well, this is where things get crazy. And this is what the 1% of the top 1% actually understand. In this scenario, this household income of $600,000 after purchasing $2 million worth of real estate, two $1 million properties, just took $600,000 in bonus depreciation across two properties year one and reduced their total taxable income from $600,000 all the way down to zero. And somewhere in Omaha, Nebraska, Warren Buffett just raised his glass of Coca-Cola at his local McDonald's, winks at you and smiles. Because you have done exactly what Warren Buffett advises. The number one rule in investing is literally do not lose money. So congratulations, you've solved for step number one, which is simply getting clear on the tax situation. But we're only 50% of the way there, because what we still need to solve for is this fascination and over-obsession with this thing called cash flow. So for the last 50 years, the reason cash flow has been the number one metric that all real estate investing gurus discuss when writing their books or preaching at their seminars is literally because there was no other leverage that the normal W-2 income earner, high income earner could take when buying real estate. But with the advent of Airbnbs over the last 10 to 50 years, or short-term rentals, the game has completely changed, and there's this new high leverage thing which everybody who's in the top 1% of the 1% is doing, which is that bonus depreciation thing. So cash flow, monthly, annually, what your property grosses minus what all your monthly expenses are, that is what is called slow money. Focusing on this is literally the old way. The new way is recognizing that there is literally hundreds of thousands of dollars in today money or fast money the moment that you close on a home and take that thing called bonus depreciation. So the old way was focusing on one variable. How much money am I making every month versus how much money am I spending? And that one variable is cash flow. But in this new equation or this new way, there are literally new variables. So what we need is a brand new equation. So what the best short-term rental investors who get this actually do is they ditch this idea of cash flow or even a cash-on-cash return, and they replace it with the true equation you need to use, which is something called IRR, or internal rate of return. An internal rate of return equation factors in considerably every single variable that goes into the down payment, the closing costs, the purchase of the home, what happens immediately after that with your tax savings, and then the slow money equation that happens over the next 1, 2, 5 years with monthly income minus your monthly expenses. The internal rate of return equation encapsulates all of that. But if you choose to say cash flow, cash flow, cash flow, cash flow is the only thing that's important to me, Well, then let's redefine what cash flow actually is, but using some of the new variables from our new equation. If we define cash flow as any financial gains that come back to me after the initial investment I make in any asset class, well, then it's appropriate to also recognize the net effective tax savings that you get from bonus depreciation literally as cash flow. If you learn to become an advanced short-term rental investor, these people who make tons of money, slash their tax bills to zero, do consider the net effective tax savings from the bonus depreciation they take on their properties as some form of cash flow in the form of an internal rate of return. So this way, when they close on a property, and let's say they buy $1 million home all in, they put 9% down with seller financing terms, so $90,000 all in down payment, plus let's say $20,000 in closing costs. So they were all into this deal $110,000. Well, they might have a net effective tax savings after their bonus depreciation of something between $120,000 to $140,000. So the old money equation would be, hey, I put $110,000 in. I need to get a 10% cash on cash return for my investment. That means I need to cash flow $11,000 over the next 12 months, or just under $970 per month on average. But a wise investor who uses the internal rate of return calculation looks at this whole investment and recognizes, I literally just put in $110,000 into an asset that had this other benefit that literally gave me back $130,000 of my own money. So I somehow put money in, got a net effective savings back that exceeded my total entry into the deal, and I got an asset that will appreciate, meaning go up in value over time, give me cash flow, the old way definition of gross monthly income minus my monthly expenses. And as time goes on, I can take leverage on this asset, meaning when it goes up in value, I can pull equity out of this deal and use it to fund future purchases, maybe 3, 4, 5 years from now. So now you understand these two concepts, which is recognizing the number one principle for investing and building wealth is to, one, not lose money on your investments. Now, your main investment right now is your active income. So don't lose $200,000 plus per year to your tax bills. And number two, make sure that when you are doing real estate, use the true definition of what is your total return, like Warren Buffett would be proud of you to do. Use the true internal rate of return calculator instead of just this one mistakenly isolated variable, which is simply cash flow. That is the difference between the two camps of people we typically work with. Camp number one is somebody who sits on their hands and says, I'm gonna do real estate, or I'm gonna do another deal. And they never end up doing more than what they've already done, because they are fixated on just cash flow. They're trying to hit a grand slam home run every time they step up to the plate and say yes or no to a deal. Whereas camp number two, the guys who are actually building wealth, saving all of their taxable income every single year, they are using the internal rate of return calculation to make it easy to recognize, yes, this deal works. I'm winning on many different variables. These are the two differentiators between the guys who end up starting and scaling their portfolios rapidly. Now, the third and final item that gets in the way from high-income earners buying real estate and wiping out their tax bills with short-term rentals specifically is literally this final thing. And this thing is the thing that is slowing people down with scaling their real estate portfolio because they're paying too much on their down payments. So the third magic item here is something called seller financing, which is this super crazy, unique mechanism that allows you, the buyer for short-term rental investment properties, to literally put 6 to 10% down on average when buying homes, instead of the traditional down payment amount, which is 20 to 25% down. Now, full disclosure, I did not invent the idea of seller financing. In fact, I stumbled backwards into this strategy about 3 years ago. So the first year that I fully dedicated myself to short-term rental real estate investing, I was doing it the old way. I was going to banks, I was getting loan products, and I was pretty much overpaying on the interest rate as well as the down payment amount, meaning I was typically putting down 20% down payments for properties that were in more centralized area, for example, just outside of Denver, Colorado, where I was living at the time, or I was putting down 25% in these more rural areas where the property was much further away from a metropolitan city, and the bank required me to put even more of a down payment down. So the problem with this was, yeah, I was buying real estate and I was wiping my tax bill out, but every time I looked at my bank account after closing on one of these deals, I was like, damn, I'm literally down a couple $100,000 after the down payment and the closing costs. I wonder if there's some crazy unique way where I can shave down the amount that I'm putting down on these down payments. And this is when I walked into seller financing strategies. So at that time, a buddy of mine who's a real estate wizard and knows all the ins and outs of creative financing introduced me to a deal that he had secured for one of he and his investing partners. And he told me, Nick, this partner is backing out because he doesn't understand creative finance. I just negotiated a deal for $1 million home to put $63,000 down. Will you do this deal with me today? So when I called my buddy back, I was as clueless as you are. I was like, how the heck are you doing this? Is this legal? Is the seller okay with this? Like, did you pull the wool over their eyes? Like, why would a seller do this? And my buddy explained this one thing that would change my entire life. He explained, this seller's name is Jimmy. The seller is 75 years old. Jimmy runs this Airbnb in Sarasota, Florida, and Jimmy is ready to fully retire. So Jimmy has this phenomenal cash flowing Airbnb property. And I asked my buddy, why in the heck would anybody part ways with this no matter how old they are? And my buddy replied that Jimmy is literally done. He is done with his investing life, done with his real estate life. He wants to hang out with his grandkids 50 hours per week. And I said, okay, this makes sense. I understand why he'd want to sell, but why would he want to sell on these terms? Like, I've sold a business before. I would never take 6 or 10% down or something crazy low. I want all of my money as today money. Why would this guy do anything different? So my buddy explained, well, in real estate investing, there's something called capital gains tax, and it's a little bit unique for this guy because he's owned that home for 17 years. So when he bought this home, it was worth $310,000. And today, it's worth roughly $1 million, and that's the price that he wants to sell it at. But here's the problem. He can't take all of that $1 million today without incurring what's called a capital gains tax. So homeowners who have bought their homes and ran them as investment properties 10, 15 plus years ago, they've seen massive appreciation or valuation increase on their homes in that period of time. And if they want to turn around and sell that home today, there is a penalty or a tax that they need to pay on all of those gains. Now, there technically is a way for those sellers to circumvent all these capital gains taxes. However, 99% of them haven't been doing this super crazy off-the-wall strategy to prevent and shield against those capital gains taxes, because 99% of people's financial advisors, CPAs, tax advisors, real estate attorneys don't even know about that strategy for shielding. And my buddy explained to me how amazing this was for us, because the guy was very, very comfortable recognizing all this, saying, if I sold this home for $1 million today, I'd probably need to pay $240,000 in taxes the moment I sell, and he doesn't want to do that. The seller was not in a position of need. He is very, very affluent, very, very well-to-do. So what he's allowed us to do is negotiate with him. We will give you a little bit of today money so that we help you shield your tax bill. And what we'll do is we'll seller finance the remainder amount owed to you with interest over time. And this blew this guy's mind. He was very, very comfortable taking a little bit of today money, which he still didn't even need, and taking what is essentially an annuity or seller finance payments to him month over month over month. And the seller was like, this solves all of my problems. I get to offload this property that I've loved. I get to spend more time with my kids. I get a super easy closing process. I get a little bit of today money so I can splurge on something with my wife. And then I get to shield my capital gains tax, meaning I don't lose almost 30% of the net worth that I've built up in this property over the last almost 2 decades. And instead, I get to shield it. I get a balloon payment years down the road. I win. The buyer wins, everybody wins. So now just over 3 years ago to date, after I closed on that home, that ended up being the best deal that I had ever closed on in my entire real estate portfolio to date. And I was blown away. And I was like, we have to teach a way for other people to know how to do this and then essentially help them do this as well. So the ability to buy low money down deals and get a low down payment and a low total entry into the deal, and have a higher or close to 1-to-1 ratio of the total bonus depreciation and then the net effective tax savings that I get from that, that is what we discovered as this golden ratio. It's doing Airbnbs for the purpose of slashing a tax bill with specifically low money down seller financing deals that allow you to play as close as possible to this ratio, which is almost like some infinite money glitch, where every year that I'm making money, I basically know I need to buy a set amount of real estate every single year and for the rest of my life while I'm an active income earner until I retire, and then I will be able to retire off of a massive portfolio of real estate. And the monthly cash flow that I get, yeah, it will probably cover my monthly expenses, but what I'm really retiring off of is my ability to sell those homes, or specifically, what's even better is take loans against the new valuation or the new appreciation of the home, pay off my existing debt on that home, and be left over with maybe $50,000, $150,000, $300,000, $400,000 after that cash out refi, and either sit on that cash, keep it in a retirement fund, deploy it into something else, buy Bitcoin when I'm 57 years old. Who cares? It's up to me. That is the strategy. That is the true name of the game. So now that you're clear on the 3 fundamental things you and every savvy short-term rental real estate investor actually needs to start their journey by getting a cash flowing property, understanding how to wipe out their tax bill, and actually doing this year over year over year, please click the link somewhere around this video, because what we as a company do is we help people save the equivalent of $300 to $400 per day on their $120,000 per year tax bill, which is essentially you driving to the Apple store and seeing an iPad mini in front of your family every day. And then those people who are in the $600,000 to $1 million plus annual income range, your tax bill is insane. It's like $200,000 to $350,000 plus every single year. Daily, that's around $600 to almost $1,200 per day. It's like smashing a foot there in front of your family every single day. So if you found this video valuable, please make sure you click the link somewhere around this video and schedule a call with our team. We specialize in helping people avoid the landmines, these major explosion points that are very, very difficult to navigate if this is your first time doing this. I know that you're smart. I know that you're a wizard at the job that you have or the business that you run, but the reality is this: you are good at your thing. We are good at the real estate thing. If there's one thing that Grant Cardone shared, which I actually appreciate, it's keep the main thing the main thing. It took us years to get really, really good at real estate. And in our process of doing this on our own, before we ever helped anybody else, we have stepped on every landmine possible. And I promise you this, it is excruciating. And we don't want to see people do that. So more power to you if you actually believe you can do this on your own. But the reality is, you haven't done it last year. You didn't do it 5 years ago. We're in 2025 and you still haven't made any progress in actually doing it this year. Click the link somewhere around this video and we'd be more than happy to actually help you out and get started with your first or your next short-term rental real estate investing property this year that cash flows, that's going to have massive tax savings, and that helps you build a portfolio of real estate that you can retire off of in the next decade and be in the top 1% of the 1%. So click the link somewhere around this video and we look forward to speaking with you soon.